remember my very first stock transaction. I was watching the news and I heard about a company called Syntex. And this was 1974. I was 16 years old. And I remember going down to the local brokerage house with my father, and they had this huge ticker tape going across the room that we were in. It was just huge. I mean, it was just a gigantic room, and there was this railing there, and all the customers sat on one side and all the brokers sat on the other. And I was just fascinated with it. I thought it was absolutely the most incredible thing I've ever seen. And I went home and I heard about this stock called Syntex that was selling, and they had made a product that I thought everybody would want. And so I said, Dad, can I buy some shares? And he said, sure, I'll buy them for you, because I was only 16 years old. I couldn't have my own brokerage account. And so we bought some shares. It was selling for about $20 a share. And within about 6 months, it was selling for $60 a share, and I made $40 a share, about $400 on the total. And I was hooked. I said, wow, this is the greatest thing in the world. In like 6 months, I could make $400, and this was 1974. That was a lot of money. So from there, I said, that's something I'm gonna keep an eye on, and I've been interested in the market ever since. And so I started to do my own research. I got the Wall Street Journal, I got Barron's, and I started looking into stocks a little bit more seriously. I looked at both fundamental data, I looked at internal market data, and I think I found something that was kind of unique in the market. You're looking at the market, well, it's going up or it's going down, it's going up, How do you measure the demand for stocks in general? Instead of individual companies. And so I started doing a lot of research into that, and I think I came up with something that was really, really important back in 1990. I was sitting in my apartment in Boston. I was in the kitchen. I had sheets and sheets of paper all over the place. I was writing down numbers. I looked like a crazy scientist, locked up in his lab, trying to investigate all this stuff. And I think I came up with some really important information that I knew probably helped determine supply and demand in the market. I didn't really know where else I didn't know how far I could take it. I didn't know at that point what to do with it, with the information. And so I set it aside, and I decided that I would come back to it at another time, because I didn't really understand what I had at the time. And then in about 2007, I had been in business for about 7 years, and computers were really, really good now. They're really, really, fast. Processors were, terrific. They were doubling every single year. And so I got this really high-powered computer and a spreadsheet, and I took my old notes that I had, all of these paper notes that I had, and I started putting them into a spreadsheet on the computer. And I started crunching some numbers. Fundamental internal market data to make a determination and quantify and measure supply and demand. And when I found it, it was just amazing. It was there it is. This is I tracked it from January of 2008, and it seemed like it was incredibly accurate. When the market went up, I could see and actually quantify the demand for stocks on that day. And when the market went down, I could quantify the selling pressure that the market was under. And then not only that, but when the market was going up, I could tell when buying was starting to die off. Buying was really strong as the market started its new advance higher, and then it started tailing off and it started to slow down. And all of a sudden, you start to see selling coming in, and I could quantify that selling. And I could see the selling coming into the market, and the market went down. So I take a look at the entire market and not just one stock. Yeah. And so, like I said, basically you can measure the demand for the stock, for a particular stock or company's products. Yeah. But you couldn't do it for the general market. How do you time your purchases? So if you wanted to say, look, I think we're going to go into a new bull market, how do you make the determination that there's more demand for stocks now that's going to last, so that you get in at a safe point and then you can get out at a safe point. And right at the bottom of the financial crisis in March of 2009, my data started picking up the fact that, hey, there was a lot of selling going on. The measurement that I did of the amount of supply in the market, the amount of selling that was going on in the market was pretty strong. It was very, very strong. As we got into January and February and March, especially January and February, it was very, very high. Lots of selling going on, unbelievable numbers. When we got into March though, towards the end of February and the beginning of March, all of a sudden I see when the market went down like a couple hundred points like it was doing almost every single day, all of a sudden the quantifiable number, which I call the market timer supply and demand number, started dropping. So I'll just give you an example. Instead of like minus 100, it was only minus 30. And then it dropped to minus 20. And then one day the market was down 258 points and it was only minus 8. And so a typical range for the supply and demand number that I use in my formulas is between 50 and minus 50. So plus 50 and minus 50. Anything out of those range is really extreme selling. And it started dropping down. All of a sudden we're down 258 points and it was only down minus 8, which was really light selling. And I said, wow, you know, selling is starting to dry up. And then on March 9th of 2009, all of a sudden the market went up like 250 points. And there was a huge amount of buying going on. And I said, wow, that's interesting. So it looks like people are starting to step into the market and start buying. The selling had dried up, and now buying was coming into the market. And then the very next day it went up like 300 points. And it was a strong, strong buying. And from the history that I used from the spreadsheet indicated that 2 days in a row of really strong selling, especially after a decline that had dried up the selling, indicates that we're going to go into a new bull run. And that's exactly what happened.